Dow? How's it going? It's midweek, it's Wednesday. Hope you guys are having a fantastic Wednesday. This is a education episode. You've seen the title. We're going to talk about Fibonacci retracements, right? What they are, how they work, how to use them. Before we get into all that, do remember to like, comment, and subscribe. And if you want to be a part of live community discussions and just be plugged into a really great community in DeFi, join the Discord. There's a link tree below. We got Twitter, we got everything, we got all of it. Now, with that said, let's get into Fibonacci retracements and what they are. Very sort of high-level overview to start with. A Fibonacci retracement is a trading tool, right? And what it does is it connects 2 points that a trader has already identified as being kind of as being of importance, I suppose, like relevant to the trade that they're looking at potentially taking. Typically, it will be a high and a low, right? That those will be the 2 points that are connected. And when you use a Fibonacci retracement, what you're trying to do is essentially identify support and resistance levels, identify potential support and resistance levels. And the way you do this is by basically dragging this tool. The tool looks like a bunch of lines on your chart, as you can see in this example here. And each of these lines corresponds to a percentage, right? And the percentages are Fibonacci numbers. And what does that mean? What's Fibonacci? Fibonacci, basically, Leonardo Fibonacci, he was a guy in Italy, Italian mathematician. His name was Leonardo Pisano Bigolo. And essentially, well, yeah, he didn't really come up with it. It started in ancient India way before. I think it was, who was it? Acharya Virahanka. Yeah, there you go. And then, yeah, subsequent generations of Indian mathematicians referenced the numbers and the method. These are the most commonly used ratios, right? 23.6%, 38.2%, 50% not officially a Fibonacci. I mean, it's used very, very frequently, but it's not officially a Fibonacci kind of percentage. You've got 61.8% and 78.6%. Yeah, obviously it shouldn't be relied on exclusively, but that disclaimer is really true of anything to do with trading. You shouldn't ever use just one specific thing. In our RSIs episode as well, we said the same thing. You know, you shouldn't just rely on an RSI. You should use all of these things in conjunction with other things as a part of a trading strategy that you've identified as being one that works for you, right? Now, you might be wondering as well why these specific numbers, right? And what is this whole Fibonacci sequence nonsense? Basically, the sequence is it's a mathematical sequence, right? In which basically each number, right, in the sequence is the sum of the two numbers before. So you would add the two numbers before it, and then that's the number, and then you add that number to the next one, and then that's the number in front of it, right? So generally starts from like 0 and 1. Some people omit the 0 because it's pointless and they just start from 1 or whatever, but it doesn't matter what you start from. That's basically the sequence. So that's the mathematical sort of what's the word I'm looking for? I suppose the foundation. Yeah, the mathematical foundation upon which this indicator or whatever functions or is built, right? So let's take this as an example. So if a price rises from $10 to $15, and these two price levels are the points that are used to draw the retracement indicator, the 23.6% level will be at $13.82. So $15, what's this? $5 times, yeah, that's the percentage, is equal to 13. That's the formula. That's the formula right there. For the 50%, again, same thing corresponds. You'll take the initial price, right? And you'll plug it into the percentage. It's just represented this way because math, right? Because it's like 100 times 100. That's what this is. That's why it appears this way. And then you get the price down here. And this is what it looks like on the actual platform. I suppose like most people use TradingView, right? It's a very simple process to use a Fibonacci retracement on TradingView. I can actually just show you guys really quickly. Random, what is this, gold? Is this gold chart? Yeah. So let's say this move down, right? From here to, okay, where did this move start? So let's say like here. Yeah, so if I wanted to do a fib, what I'm essentially trying to do is so this is what you do. You like click here, the high and the low, drag it down to the low, and you'll have, I'll just set it so the, like it's all the way over here to the right that I've dragged it, but as you see the line hits here. So this over here, this space basically is filled, it's cut through with lines, right? And the price action will basically either retrace or not retrace. And that'll kind of like fortify your position. So for this specific example, if I had been looking for a long, that would have been a very bad idea because as you can see at this point, yeah, wait, let me drag this back up. So the price, from here, the price never retraced up beyond 50%. It never did. It never did, right? Literally, it never did. So that would have probably been a bad trade. I wouldn't have taken that trade. At this point, when it didn't touch this, it didn't cross it, formed a high, formed a lower high. At that point, you know, you would just get out. But then again, like we said, don't just use this exclusively. Use this as a part of a trading strategy that works for you. Now, there's nothing to really calculate when it comes to Fibonacci retracement levels, just percentages of whatever price range is chosen. And the origins, yeah, absolutely are fascinating. They're based on something called a golden ratio. Here's a interesting picture, the sacred geometry overview, 5 platonic solids. You got the tetrahedron, hexahedron, octahedron, icosahedron, and the dodecahedron. Sacred geometry, man. Look at this. So essentially the golden ratio, start a sequence with a sequence of numbers with 0 and 1. Keep adding the prior 2 numbers to get a number string like this. So that's the Fibonacci sequence right there. Each number in the sequence is the sum of the 2 preceding numbers. And the string continues indefinitely. And Fibonacci retracement levels are all derived, these percentages, they're all derived from that specific sequence, that type of sequence, right? That number string. After the sequence gets going, dividing one number by the next number yields 0.618 or 61.8%. Divide a number by the second number to its right, and the result is 0.382 or 38.2%. So on and so on. You get these numbers that we've identified up here: 23.6, 38.2, 61.8, 78.6. Fun fact, the golden ratio, known as the divine proportion, can be found in various spaces, from geometry to human DNA to everything. All of nature, as you can see these examples here as well. What is this, like an aloe vera plant, the inside of a sunflower, a nebula or a galaxy, I don't know what that is, and like a conch shell, and just the human body itself, like everything is, it's just really interesting stuff to do research into in your own time, in addition to, using it as just a trading tool, understanding the foundations of everything. That's a pretty lofty kind of goal to work towards. So Fibonacci retracements can be used to place entry orders, determine stop loss levels, set price targets. A trader may see a stock moving higher up. After a move up, if it retraces, after a move up, it retraces to the 61.8% level, and then it starts to go up again. Since the bounce occurred at a Fibonacci level during an uptrend, the trader decides to buy. So as you can see here, I'll generally look for between 70 and 79%. If it forms something here, if it treats this area as like a support or a resistance, that's a support or a resistance that I'm more likely to trust, if that makes sense. The trader might set up a stop loss at the 61.8% level, as a return below that level could indicate that the rally has failed. Yeah, of course. Like we said, don't ever use this exclusively. Always exercise strong, highly cautious risk management. It's very, very important. And learn about like risk to reward ratios as well before you ever enter a trade. Fibonacci levels also arise in other ways within technical analysis, within TA. They're prevalent in Gartley patterns and Elliott wave theory. These are things that we will cover in further episodes. After a significant price movement up or down, these forms of TA find that reversals tend to occur close to certain Fibonacci levels. And again, yes, absolutely, use other analysis tools in conjunction with the Fibonacci approach. Fibonacci retracement levels are static, unlike moving averages or anything like that. What that basically means is they're not dependent on fluctuations of price, right? So like a moving average averages movement of price. An RSI, relative strength index, shows momentum as a result of, well, not as a result of, but it basically presents momentum based off of data, and that data is the fluctuation of price or the movement of price. The Fibonacci retracement tool does not depend on price. As you can see, I don't need price at all. I can just drag this from here to here, and there's no freaking price at all over here, right? But if I needed to do an RSI, or let's see, a moving average, you see that dependent on price. It doesn't go beyond here. That's what that means. That helps traders and investors to anticipate and react prudently when the price levels are tested. These levels are inflection points where some type of price action is expected, either a reversal or a break. So now you know what it is, how to use it. Let's talk about the limitations, right? So while these retracement levels indicate where the price might find support or resistance, there's really no assurance at all that the price will actually stop there. This is why other confirmation signals are often used, such as the price starting to bounce off of the level, right? Not just entering or existing within that level. Like if it needs to do something there, it needs to like bounce, it needs to form a high or a low or something like that. The other argument against Fibonacci retracement levels is that that there are often so many of them that the price is likely to reverse near one of them quite often. The problem is that traders struggle to know which one will be useful at any particular time. When it doesn't work out, it can always be claimed that the trader should have been looking for a different or another Fibonacci retracement level. But then again, like we said, it should not ever be used exclusively. You'd run into that problem if you only use a Fibonacci retracement as your only confirmation for entering a trade. Otherwise, use it in conjunction with an MA, with an RSI, and with just with price action. Look at price action, identify the trend, and if it seems to make sense, look at previous data, identify support and resistance levels. If it's basically, if what the Fibonacci retracement is telling you is being backed up by a number of other things, then that's something you should listen to. So we've covered the ratios, we've covered how to apply the retracement levels in a chart. I've opened up TradingView, I've shown you how to do that, shown you how to draw it, shown you how to read it. I think that's enough information on the Fibonacci retracement levels. If you do have any further questions or anything further to add about this sacred geometry stuff, if you have any interesting anecdotes or just something you want to share, drop it in the comments section below, and do join the Discord as well. I have been your host, Dharma Sutra. Thank you so much for being a part of it. Hope you learned something today. Enjoy the rest of your day. Bye-bye.